Good morning. This is an open meeting of the U.S. Securities and Exchange Commission on September 14th, 2022, and I want to welcome members of the public who are listening in. Today, the Commission will consider whether to propose amendments to the standards applicable to covered clearing agencies, so-called clearinghouses, for U.S. Treasury securities regarding their membership requirements as well as risk management, and amendments to the broker-dealer customer protection rule regarding margin held at those covered clearing agencies. I'm pleased to support this proposal and look forward to today's presentations. I will now turn over to Division Director Hashang Zhu from Trading and Markets to introduce the proposal, and I think he'll have Elizabeth Fitzgerald with him, and then we'll hear from our head of the Division of Economic Risk and Analysis, Jessica Wachter. But over to you, Hashang.
Good morning, Chair Gensler and Commissioners Peirce, Crenshaw, Ueda, and Lizarraga. Today, the Division of Trading and Market recommends changes to two sets of Commission rules under the Exchange Act. First, we recommend amendments to the covered clearing agency standards to require that all Treasury repo transactions with the direct participants of a Treasury clearing agency and certain Treasury cash transactions with the direct participants to be centrally cleared, with limited exceptions. Second, we recommend additional requirements to improve the risk management practices at the Treasury securities clearing agencies and incentivize and facilitate additional central clearing in the U.S. Treasuries market without diminishing customer protection. Now, the first set of recommendations establishes new membership requirement for covered clearing agencies providing central clearing for U.S. Treasury securities. Specifically, under the proposal, these clearing agencies must have policies and procedures to require that their direct participants submit for clearance and settlement all eligible secondary market transactions. The definition of eligible would include all repurchase agreements, namely repo trades, collateralized by U.S. Treasury securities, in which one of the counterparties is a direct participant of a clearing agency. The definition would also include certain specified repurchase and sales or cash transactions of U.S. Treasury securities by direct participants who are interdealer brokers, as well as those cash transactions between, on the one hand, direct participants of a clearing agency, and on the other hand, registered broker-dealers, government securities brokers, government securities dealers, hedge funds, and other levered accounts. The proposal would exclude all transactions between direct participants and specified types of counterparties, that is, central banks, other sovereign entities, international financial institutions, and natural persons. Now, to be clear, because the proposal centers on clearing agencies and their direct participants, Treasury transactions between two parties who are not direct participants of any Treasury clearing agency are generally out of the scope of the part of the proposal that I just discussed. Now, the division believes that the proposal will increase the use of central clearing, which will improve risk management by covered clearing agencies in the U.S. Treasuries market, and further facilitate prompt and accurate clearance and settlement in this market in a number of ways, including the reduction of counterparty credit risk, centralized default management, increased multilateral netting, and improved transparency and resilience of the U.S. Treasuries market. If more transactions are required to go through the clearing agencies, it is all the more important to make sure that the clearing agencies improve their risk management practices, protect customer assets, and facilitate access to clearance and settlement services. And that's precisely what we aim to achieve with our second set of recommendations. It has three components. The first component is that Treasury clearing agencies must have policies and procedures to calculate, collect, and hold margin for direct participants separately from margin related to customer transactions. For example, if a direct clearing member trades with his customer, one side of the trade would show up in the house account and the other side show up in the customer account. This separation allows for better understanding of the potential risks arising from centrally cleared U.S. Treasury security transactions, and therefore better risk management. For the second component, the division is recommending amendments to Rule 15C33A to permit margin required and on deposit at the covered clearing agency for U.S. Treasury securities to be included as a new debit item in the customer reserve formula, subject to certain conditions designed to ensure maximum protection of a broker-dealer's customers. Essentially, this change would require a broker-dealer to onward post margin collected from its customers to the covered clearing agency to meet the margin requirement at the clearing agency that arise from the customer's trades. The division believes that amending Rule 15c3 would facilitate and incentivize additional central clearing by reducing broker-dealers' cost of funding margin payments on behalf of customers. And finally, the division recommends proposing that covered clearing agencies in the U.S. Treasuries market have policies and procedures to ensure that they have appropriate means to facilitate access to central clearing, including those of indirect participants. This provision would not prescribe a particular client clearing model, but instead would require that the covered clearing agency review its indirect access models and ensure that the model facilitate access to clearance and settlement services by indirect customers. In a moment, I will introduce Elizabeth Fitzgerald in the Office of Clearance and Settlement, and then Randall Roy in the Office of Broker-Dealer Finances, who will discuss the proposed rule changes in more detail. Before I do, I'd like to take a moment to thank our colleagues from across the ICC that contributed to this proposal, including staff in the Division of Economic and Risk Analysis, the Division of Investment Management, the Division of Enforcement, the Division of Examinations, and the Office of the General Counsel. Their input was invaluable in preparing this proposal. I'd also like to thank our colleagues in the Treasury Interagency Working Group from the U.S. Department of the Treasury, the Board of Governors of the Federal Reserve, the Federal Reserve Bank of New York, and the U.S. Commodity Futures Trading Commission. I will now turn this over to Elizabeth. Thank you.
Thank you, Ishan. Good morning, Chair Gensler and Commissioners. The Division is recommending several rule changes today related to covered clearing agencies in the U.S. Treasury market. I will now provide a brief overview of each proposed change to portions of Exchange Act Rule 17 AD 22, which encompasses what we call the covered clearing agency standard. As Ishan previously discussed, the Division recommends that the Commission propose an amendment that would impose a new membership requirement on covered clearing agencies that provide central counterparty services for U.S. Treasury securities. Specifically, the proposal would build on existing rules in place at the covered clearing agency in the U.S. Treasury market, and it would require that a covered clearing agency have written policies and procedures reasonably designed to establish objective, risk-based, and publicly disclosed criteria for participation, which, in turn, require that the direct participants of the covered clearing agency submit for clearance and settlement all eligible secondary market transactions to which they are a counterparty. The proposal would also define the scope of what constitutes an eligible secondary market transaction and what would therefore be subject to this membership requirement. The proposed definition of an eligible secondary market transaction is made up of 4 separate categories. First, it would include all repurchase agreements collateralized by U.S. Treasury securities to which a direct participant of the covered clearing agency is a counterparty. Second, it would include all purchases and sales of U.S. Treasury securities entered into by a direct participant of the covered clearing agency that is serving as an interdealer broker, meaning that the direct participant brings together multiple buyers and sellers using a trading facility and is a counterparty to both the buyer and seller in 2 separate transactions. Third, the definition would include any purchase or sale between the direct participant of the covered clearing agency and a registered broker-dealer, government securities dealer, or government securities broker. Finally, it would include any purchase or sale transaction between a direct participant and a hedge fund or a particular account that can take on specified amounts of leverage. A hedge fund would be defined in the proposed rule in a manner consistent with the Commission's definition in Form PF, and the account would mean an account at a registered broker-dealer, government securities dealer, or government securities broker, where such account may borrow an amount in excess of 1/2 of the net value of the account, or may have gross notional exposure of transactions in that account that is more than twice the account's net value. The definition would also exclude transactions with certain types of counterparties from its scope. Transactions with central banks, sovereign entities, international financial institutions, and natural persons would not be considered eligible secondary market transactions. Also, in connection with the new membership requirement, the proposal would require that covered clearing agency have policies and procedures reasonably designed to identify and monitor their direct participant submission of transactions for clearing, including how the clearing agency would address a failure to submit such transactions. In addition, the Division recommends several amendments to the covered clearing agency standards related to risk management at covered clearing agencies in the U.S. Treasury market. these clearing agencies would be required to establish policies and procedures reasonably designed to calculate, collect, and hold margin amounts from a direct participant for its proprietary U.S. Treasury securities positions separately and independently from margin calculated and collected from that direct participant in connection with transactions by an indirect participant. The staff believes that this aspect of the proposal should allow for a covered clearing agency to have a better understanding of the source of potential risk arising from the U.S. Treasury securities transactions it clears, and therefore to better manage that risk. Staff also believes that it should potentially further incentivize central clearing. Lastly, the division recommends changes regarding access to covered clearing agencies in the U.S. Treasury market. The proposal would require that a covered clearing agency establish written policies and procedures reasonably designed to ensure that it has appropriate means to facilitate access to clearance and settlement services of all eligible secondary market transactions in U.S. Treasury securities, including those of indirect participants, and to require that its board of directors review those policies and procedures annually. To be clear, this provision would not prescribe specific models or methods or client clearing models for market participants to obtain indirect access to U.S. Treasury securities clearing agencies. But it is designed to help ensure that the covered clearing agencies review their indirect access models and that they facilitate access to clearance and settlement services in a manner suited to the needs and regulatory requirements of the market participants throughout the U.S. Treasury securities market, including the indirect participants. And now I'll turn it over to Randall Roy to describe the proposed changes with respect to Rule 15c3.3.
Thank you, Elizabeth. Good morning, Chair Gensler and Commissioners. The division is recommending proposed amendments to Rule 15c3-3A. Currently, Rules 15c3-3 and 15c3-3A, also known as the Customer Protection Rules, do not permit broker-dealers to include a debit in the customer reserve formula equal to the amount of margin required and on deposit at a U.S. Treasury securities covered clearing agency. In addition, no covered clearing agency in the U.S. Treasury market has implemented rules and practices designed to segregate the margin and to limit it to being used solely to cover obligations of the broker-dealer's customers. This means that increases in the amount of margin required to be on deposit at a covered clearing agency as a result of the recommended additional membership standards would result in corresponding increases in the need for broker-dealers to use their own cash and securities to meet these requirements. To facilitate implementation of the changes to the covered clearing agency standards that Elizabeth just described, the division recommends that the Commission propose to amend Rule 15c3-3A to permit margin required and on deposit at a U.S. Treasury securities covered clearing agency to be included as a debit item in the customer reserve formula, subject to certain conditions designed to ensure maximum protection of a broker-dealer's customers. This new debit item would offset corresponding credit items in the reserve formula and thereby free up resources that could be used to meet the covered clearing agency's margin requirements. The goal is to facilitate implementation of the additional membership standards in a way that does not diminish the customer protection objectives of Rules 15c3-3 and 15c3-3A and incentivizes additional central clearing. Now I will turn the meeting over to Jessica Wachter of the Division of Economic and Risk Analysis to discuss the economic impact of the proposed rule changes. Jessica?
Thank you, Randall and Elizabeth and Haosheng. Good morning, Chair Gensler and Commissioners. Today, as you've heard, the Commission is proposing rules to amend the standards applicable to covered clearing agencies for U.S. Treasury securities. Broadly speaking, eligible secondary market transactions in the Treasury market can be divided into two categories: cash transactions and repurchase transactions. Cash is what most people think of when they think about trading securities. A trade takes place, and if all goes as planned, a short time later, typically one day in the Treasury market, cash and securities are exchanged. In contrast, the repurchase market functions more like loans collateralized by Treasury securities. Repurchase agreements, or repo, can reference specific securities, thus the name repurchase, sale of a security with an agreement to repurchase later, or it can reference a basket of securities, in which case it's more like a collateralized loan. Repurchase agreements can be overnight or for a fixed term, like several months. The proposal's requirement to centrally clear transactions differs for repo and cash. The repo market tends to feature large, sophisticated players. The Commission is proposing that CCAs have policies and procedures reasonably designed to require direct members to submit for clearing all eligible repo transactions with any counterparty other than specific entities like central banks described in the proposal. Participants in the cash market are more heterogeneous. The Commission has identified two categories of cash purchases and sales that would be part of the proposal. The first is those using an interdealer broker. That's a trading facility that brings together multiple buyers and sellers, and after the trade becomes the counterparty to both. These trades are particularly important because should one of these trades be centrally cleared and the other not, from the point of view of the clearing agency, the IDB has a directional position and must post margin, even though there is in fact an offsetting transaction. Because the IDBs are nodes of the trading system, their stability is particularly important. So that's one category. The second category is trades between a CCA member, so any type of member, not necessarily an IDB, and a registered broker-dealer, a government securities broker, government securities dealer, a hedge fund, or an account with sufficient eligibility to borrow. So we believe that this will increase the use of central clearing, either through the membership proposal, like I just described, or indirectly through incentive effects, such as the ability to use clients' funds towards clients' margin, as Randall discussed. A primary benefit of clearing is the greater use of netting. Think of a web of bilateral connections replaced by a simpler hub-and-spoke model. Each one of the many previous bilateral connections represents a potential point of failure. Thus, going from this web to the simpler model means that risks can be orders of magnitude lower. It means reduced need for collateral. It also means reduced risk of settlement fails. The benefits are particularly large in the case of IDBs, as discussed, in which a large unnetted position is replaced by a netted position. It may also be important in the case of levered participants, in which large concentrated positions can occur and create a risk of a fire sale. We believe that central clearing will increase the competition for liquidity provision also. That will lower trading costs and it will increase resiliency, as has occurred elsewhere when central clearing has been introduced. And it will separately increase the efficiency of the trading process. We acknowledge that this proposal comes with costs. There may be direct costs of increased clearing, such as fees, margin, and the need to contribute to the liquidity facility. Increases in margin may be alleviated by the ability to onward post margin. There may be costs associated with the need to establish clearing relationships. The degree of these costs depends on how membership requirements evolve and how a model for indirect customer clearing develops. The requirement to facilitate access, as Elizabeth talked about, may alleviate these costs, and we request comment on other costs. In closing, I want to express my thanks to our colleagues from the Division of Trading and Markets and the Office of the General Counsel and others for their collaboration, and I thank you for your attention.
Thank you so much, Hashang, Jessica, Randall, and Elizabeth for your presentations. Commissioner Peirce.
Thank you, Mr. Chair, and thanks to Hashang, Elizabeth, Randall, and Jessica. I support today's proposal because it seeks comment on how to address problems we have observed in the Treasury market, not because I necessarily embrace the solution that we're proposing. Over the past several years, regulators, market participants, and academics alike have devoted increasing attention to the Treasury market. Some of this attention stems from the nature of the market. No market is larger or deeper. None facilitates such a wide range of activities, including effectuating the U.S. government's fiscal, monetary, and regulatory policy, and serving investors' hedging, liquidity, and investment needs. Treasury issuance has exploded in the last 2 decades. The proposing release notes that the volume of marketable U.S. Treasury securities outstanding has increased by approximately 18 trillion since 2000, or as a recent interagency report notes, Treasury debt held by the public totaled 5.1 trillion, or 35% of 2007's GDP, and 21.6 trillion, or 101% of 2020's GDP. The growth in the national debt is concerning for a citizen, but regulators thinking about market quality also quite naturally sit up and take notice. Some of the attention stems from periodic dislocations that are disconcerting in a market of such size, importance, and historic stability. Most recently, for example, in the wake of the COVID-19 outbreak and the governmental responses to it, market participants fled from rather than to the Treasury markets. We can't write off this market disruption as just another pernicious result of the pandemic and associated government actions. The events of March 2020, although prompted by an unusual set of events, may signal deeper problems in the Treasury market. Indeed, disruptions in this market have become notoriously common, including a flash rally in October 2014 and stress in the repo market in September 2019. Attention on Treasury markets also comes in response to changes in how the market operates and in the roster of market participants. The Treasury markets have increasingly shifted to electronic trading, which has facilitated greater participation in the market by principal trading firms. These firms use trading strategies and exhibit trading behaviors that can differ significantly from primary dealers. As the role these firms play in the market has increased and dealer balance sheet space devoted to the Treasury markets has shrunk, the proportion of interdealer transactions that are cleared has declined significantly. Finally, some of the attention on the Treasury market comes from the unique regulatory structure for the market. Congress has allocated oversight of the Treasury market across several different authorities, including the Federal Reserve Board, the Federal Reserve Bank of New York, the Office of the Comptroller of the Currency, the CFTC, and the Commission. Given the fragmentation of oversight, no single regulator can implement a market-wide solution to perceived problems. At the same time, any significant issue in the market is likely to attract the attention of most or all of these bodies. Translating this attention into coherent policy can be challenging. In light of the Treasury market size and recent history of disruptions and change, regulators have a responsibility to examine the market and to devote careful consideration to whether regulatory changes may be warranted. Today's release is the product of careful consideration by the Commission staff. Through its many questions, the release invites the public to further our consideration with comments based on, among other things, the experience and expertise that comes from being in the market. In a moment, I will add some additional questions to the list. Both regulators and market participants have discussed the possibility that expanded central clearing could help prevent further disruptions by improving and standardizing risk management, netting gross exposures, enhancing transparency, and facilitating further evolution in market structure that could reduce barriers and improve liquidity. As former Commissioner Roisman explained, the rise of electronic trading presents great opportunity for investors, but it also may increase risk of non-performance by counterparties. He suggested that increased central clearing and thus increased novation, netting, and guaranteed settlement could make the market more resilient. Today's proposal represents one approach to increasing central clearing of Treasury transactions. The proposed rule amendments, if adopted, would effectively require most Treasury transactions that clearing agency members enter into with a large class of counterparties to be cleared. Treasury clearing agencies, of which there is now only one, the FICC, would have to calculate, collect, and hold margin from direct participants separately from indirect participants' margin. To accommodate the anticipated increased demand for clearing, the proposal also would require clearing agencies to have policies and procedures to facilitate broader access to clearing and settlement services. Finally, the proposal would amend the broker-dealer customer protection rule to facilitate the posting of customer margin to the clearing agency in connection with Treasury transactions. The proposal takes a considerably heavier hand to achieve the goal of increased central clearing than seems necessary or desirable. I have several specific questions designed to explore whether we could and should approach the problem with a lighter touch. First, does the proposal adequately grapple with the complex set of trade-offs associated with central clearing? The proposal seems simply to assume that the more Treasury transactions that are cleared, the better. Any limitations on the reach of the proposed mandate seem driven not by careful considerations of the policy trade-offs, but by how far it seems appropriate to extend the membership requirements under our rules. Yes, central clearing can produce significant benefits, including encouraging higher and more transparent risk management standards, netting trades to reduce gross exposures and increase balance sheet capacity, and mutualizing risk in a way that can reduce the contagion risk of firm failure. But central counterparties also can have unpredictable effects on risk. They concentrate risk, which under certain circumstances can increase risks to the market more broadly. They also can transmit risks from a failing member to other members. They may increase moral hazard. And through the use of standardized models, they may increase the risk that erroneous models applicable to all participants may present to the market. And because they generally can make changes to risk management only subject to commission review and approval, they can decrease the flexibility of the market during extreme market events. Does the proposal take sufficient account of complexity and potential unintended effects of the proposed clearing mandate? For example, the clearing mandate, if adopted, likely would increase costs of transacting in the Treasury market. Would these higher costs force some participants out of the market? And if so, what effect would these exits have on liquidity? Perhaps the effects would be more nuanced and more pernicious. For example, perhaps the higher costs of transacting Treasuries instead or also make it more likely that some firms that are not clearing agency members will seek out counterparties that are also not clearing members. If so, would more creditworthy firms be able to transact with counterparties that don't trigger the clearing requirement? Would the result be a clearing mandate that applies disproportionately to transactions between members and firms that are less creditworthy on average, and that therefore may present relatively greater risks to their counterparties and to the clearing agency? Under the Clearing Access Amendment, could the clearing agency feel pressure to prove that it has in place the required policies and procedures by granting easy access to the less creditworthy firms doing business with its members? Is FIC able to handle the risk associated with the new transactions it would have to clear if the mandate were adopted? The proposal would increase the size and complexity of the clearing agency's task. Some people assume that regulatory oversight will ensure that the clearing agency manages risk appropriately, but regulators don't always get it right either. Would the other proposed amendments, aside from the clearing mandate, shift incentives sufficiently on their own to produce a significant increase in clearing without a mandate? Many market observers agree that increasing the level of central clearing in the Treasury market is desirable, but have cautioned against imposing a mandate given the difficulty of understanding and balancing the trade-offs of such a requirement. As Marta Chafee and Sam Schulhofer-Wohl have explained, the changes that would need to be made to make mandatory clearing feasible, changes that could include improving access to clearing and modifying customer protection requirements, which are being proposed today, may themselves improve incentives for central clearing sufficiently to produce some or most of the increase that would be attained by a clearing mandate. Why not start with a less prescriptive approach and move to the mandate only if those other measures prove insufficient? Is the Commission overstepping its bounds and encouraging the FIC to overstep its bounds by imposing this requirement as a requirement of membership in the clearing agency? The release argues that members of the clearing agency who do not clear all of their cash or repo Treasury securities transactions, quote, create contagion risks to clearing agencies clearing and settling in these markets, as well as to the market as a whole, and implies that because increased clearing may ameliorate this risk, it's appropriate to require FIC members to clear even trades with non-members. This reasoning establishes a potentially dangerous precedent for allowing or requiring the clearing agency to regulate directly any activity of members and indirectly the activity of non-members as well. What are the limits of such authority? Could the clearing agency forbid clearing members from entering into transactions with a counterparty whose activities it determines marginally increase the risk the counterparty presents to the clearing agency, such as a hedge fund that doesn't margin its bilateral trades with counterparties that aren't members of the clearing agency, or that invest in both treasuries and Bitcoin? So thank you in advance to the commenters who will help us to think through the proposal, the complexities around it, and reasonable alternatives. I do have a question for the staff. Transactions with sovereign entities, including potentially sovereign wealth funds and central banks, would be excluded from the clearing requirement. Am I to infer from this exclusion, which seems to reflect in part a concern that the clearing requirement could interfere with important government objectives, that the cost and inflexibility imposed on counterparties whose transactions would be covered are going to be substantial?
Sure, I'd be happy to answer that from the trading and market staff. I think our view is that the proposed exclusion, the official sector exclusion is what it's referred to in the release that you mentioned, Commissioner Peirce, is not really arising from a concern that the requirement for direct participants to clear transactions, if it applied to, say, central banks or the other excluded entities, would interfere with the government objectives or otherwise impose too great of a burden on those transactions. But I think instead it reflects a view that it wouldn't be appropriate to require those types of governmental entities to be scoped into the requirement out of sort of deference to the role of the Federal Reserve and other central banks in setting monetary policy. And also for the foreign central banks, I think we sort of had thoughts of international comedy involved as well in terms of sort of having similar treatment in other jurisdictions for our central banks. It's similar to the exclusion that was put in place with respect to the swaps mandate at the CFTC. I think the other thing, and we mentioned in the release as well, is the view that such transactions generally pose little, our belief is that they would pose little to no risk to a clearinghouse, and the types of activities that we envision here would be more like an unlevered investment in U.S. Treasury securities for, say, cash management or foreign reserve management. I think that was the answer. I'm sorry if I missed anything.
Well, so it sounds like the rationale you provided doesn't as much apply to something like a sovereign wealth fund. So it sounds like those you might be thinking of differently.
I think that's a fair point, yes. And I think, with respect to sovereign wealth funds, we actually sought comment, or we would propose rather to seek comment in the release on whether they should be scoped into this official sector exclusion, whether they would fit within the proposed definition of a sovereign entity at all, and sort of whether they would pose the same types of risks, or where they fit in the spectrum, and to allow us to get feedback as to how to handle those kinds of entities and make sure that sort of we're, to the extent that they are, closer to, say, a more leveraged strategy, like a relative value arbitrage or things like that, that we would be able to scope them. We want to hear feedback on whether or not it would make sense to kind of lump them together with the official sector.
Okay, thanks, Elizabeth. I appreciate it. And thank you to you and your colleagues in the Division of Trading and Markets and Economic and Risk Analysis, the Office of General Counsel, and others throughout the Commission for your work on the proposal. Thanks also to our counterparts across the government for their help. And thank you, Hao Shang and team, for your discussions with me about the current state of the Treasury market and the future state that we hope the proposal will produce. I don't have any additional questions. Thanks.
Thank you, Commissioner Peirce. Commissioner Crenshaw.
Morning, thank you. As I've noted in the past, it's hard to overstate the importance of the U.S. Treasury market. U.S. Treasury securities are direct obligations of the U.S. government issued by the Department of the Treasury. There are several different types of Treasury securities, including U.S. Treasury bills, nominal coupon notes and bonds, floating rate notes, and Treasury inflation-protected securities, or TIPS. The market consists of two components, as you've heard from some of my colleagues today: the primary market and the secondary market. The primary market is where the Treasury Department auctions securities to the public through a competitive bidding process and subsequently issues awarded securities to finance the federal government. The secondary market is where the subsequent trading of the U.S. Treasury securities occurs. The secondary market includes both the cash market that you heard Jessica talk about for outright purchases and sales of securities, and the repo market, where one participant sells a U.S. Treasury security to another participant, along with a commitment to repurchase the security at a specified price on a specified later date. Treasuries serve as investment instruments and hedging vehicles, as a benchmark for many financial instruments, and as a mechanism for the implementation of monetary policy, among other purposes. And with thanks to my colleagues in the Division of Economic and Risk Analysis, I'll briefly highlight a few additional statistics, in addition to the ones Commissioner Peirce noted, to help illustrate the importance of the Treasury market. The average weekly trading volume in the Treasury cash market is approximately $3 trillion. The average daily volume in the Treasury repo market is almost $4 trillion. The total amount outstanding of marketable U.S. Treasury securities held by the public is around $23 trillion. and trading in the U.S. Treasury market accounts for approximately 65% of all trading in fixed income securities. For these and other reasons, the U.S. Treasury market is often referred to as the deepest and most liquid market in the world. Confidence in the Treasury market is central to the functioning of the U.S. financial system and to the global economy more broadly. And the structure of the Treasury market has, as you've heard, undergone significant changes over the last 20 or so years. Many of these changes, as you've also heard, stem from increased use of technology and automation, and the emergence of principal trading firm entities, or PTFs, that have deployed technology-based trading strategies. Before the mid-2000s, most interdealer trading occurred between primary dealers, and the transactions were centrally cleared. That is, cleared and settled by a central counterparty that interposes itself between the counterparties to the transaction, acting functionally as the buyer to every seller and the seller to every buyer, thus reducing risk that a transaction will fail and increasing efficiency. However, in recent years, the share of trades on interdealer broker platforms executed by non-dealers, like PTFs and hedge funds, has grown, with a corresponding decrease in the level of central clearing. There has also been a number of recent disruptions in the Treasury market, which my colleagues have also mentioned, including the flash rally of October 2014, the sudden spike in repo rates in September of 2019, and the COVID-related market disruption in March of 2020. These events triggered extensive interventions by the Federal Reserve and have prompted regulators, industry groups, and academics to consider ways to improve the resilience of the market in times of stress. Increasing the level of central clearing in the Treasury market has been identified in numerous papers, reports, and speeches as one way to do so. The amendments we're considering today are designed to promote central clearing in the Treasury market in 4 ways. First, the proposal would require covered clearing agencies that clear Treasury securities, currently only the Fixed Income Clearing Corporation, to require all of their direct participant members to submit eligible secondary market transactions in Treasuries for clearance and settlement. Second, the proposal would require certain changes to strengthen risk management practices at covered clearing agencies that clear Treasury secretaries, specifically with respect to the separation of margin for proprietary positions from margin for other transactions. Third, the proposal would require a covered clearing agency that clears Treasury securities to ensure that it has appropriate means to facilitate access to clearance and settlement services of all eligible secondary market transactions in U.S. Treasury securities, including those of indirect participants. Finally, the proposal would amend the broker-dealer customer protection rule to permit margin required and on deposit with the covered clearing agencies for Treasury securities to be included as a debit in the reserve formulas for accounts of customers and proprietary accounts of broker-dealers. The potential benefits of central clearing are numerous. Increased central clearing in the Treasury market should decrease the overall amount of counterparty risk, reduce contagion risk in the Fixed Income Clearing Corporation, help avoid disorderly member defaults, and increase multilateral netting of transactions, which should in turn reduce operational and liquidity risks. It should also improve transparency in several ways. First, expanded central clearing should increase regulators' visibility into these markets, in particular, the often opaque repo market. It should also improve transparency of settlement risk to regulators and market participants and increase price transparency. There are other considerations. In particular, while central clearing reduces counterparty and operational risks, it also concentrates risk in one entity. This underscores the importance of effective risk management at clearing agencies, and the importance of appropriate supervision and regulation of those institutions. There could also be an increase in the cost to participate in the Treasury market associated with the amendments. However, additional costs are likely to be offset by the netting benefits that should result from additional centrally cleared transactions. Some may query whether a requirement for FIC members to clear eligible secondary market transactions is necessary, given that the amendments to the customer protection rule and the changes to margin practices may, on their own, result in an increase in the level of central clearing in the Treasury market. However, as noted in the release, the benefits of central clearing are proportional to the number of participants. The higher the number of participants, the greater the benefits of central clearing. And central clearing requires participants to incur short-term private costs in order to obtain a larger, longer-term collective benefit. In other words, central clearing can present a collective action problem. And in the absence of a meaningful inducement to partake, market participants may not do so. The proposal would provide that inducement through a membership requirements, and I therefore consider that aspect of the proposal foundational. I look forward to reviewing the comments. In particular, I look forward to commenters' views on the scope of the proposed requirements regarding direct member transactions in the secondary market and whether they may be under or over-inclusive. I'm also interested in commenters' views on the appropriate schedule for implementation. And finally, I'd like to join my colleagues in thanking our fellow regulators for their input, in particular through their participation in the Interagency Working Group on Treasury Market Surveillance, comprising staff from the Department of the Treasury, the Federal Reserve Board of Governors, the Federal Reserve Bank of New York, the Commodity Futures Trading Commission, and the SEC. I'd also like to thank the staff in the Division of Trading and Markets, the Division of Economic and Risk Analysis, and the Office of the General Counsel for all of their hard work in the proposal. I'm pleased to support it today. Thank you.
Thank you, Commissioner Crenshaw. Commissioner Ueda.
Thank you, Chair Gensler. Good morning, everyone, and thank you for the presentations. U.S. Treasury securities serve as a foundation and a key linkage in both domestic and international financial markets. The U.S. Treasury market is the deepest and most liquid government securities market in the world. Treasury securities are used by a wide range of market participants, including seniors on fixed incomes building their retirement portfolios and foreign governments investing their U.S. dollar reserves. For instance, market participants use Treasury securities as investment hedges in portfolio construction to generate stable low-risk returns and in interest rate investment-based strategies. Treasury securities are also the primary means of financing our ever-expanding federal deficit. The Treasury market, however, has experienced significant stresses in recent years, including the September 2019 repo pressures and the March 2020 pandemic-related dash for cash. Since the late 1980s, central clearing for Treasury security transactions in the cash market have existed in the interdealer broker segment through the Fixed Income Clearing Corporation, which is overseen by the Commission. Fixed model was formulated before the entrance of principal trading firms as significant participants in the Treasury markets in the early 2000s. Former Commissioner Roisman has noted expanding access to central clearing could have positive effects on market breadth and depth, yet also cautioned that the Commission should carefully consider whether we have adequate safeguards for ensuring that we do not further entrench entities as systemically important. Others have noted that while central clearing will certainly be a key element of the debate around Treasury market reform, it should be subject to thorough study to assess both its costs and its benefits, and particularly how different segments of the market may be impacted by additional clearing before reforms are undertaken. With these proposed amendments, the Commission takes an important step in seeking an improved regulatory framework for central clearing of Treasury securities. Increasing access to central clearing may result in additional transparency, provide more comprehensive data on trading, and in certain instances, promote sounder risk management practices. I am interested in hearing commenter views on the questions raised in today's release, including whether increasing access to central clearing can be achieved without leading to the entrenchment of larger firms. Are there mechanics and incentives that would increase the amount of Treasury security transactions that are centrally cleared without imposing a mandate? Are there approaches that promote competition? How can robust risk management practices be achieved? While the balance between an overly prescriptive approach and a framework that incentivizes central clearing might be difficult to achieve, can be crucial to a more resilient market structure. Lastly, given the complexities associated with the regulation of the Treasury market and the critical role it plays in the global economy, I would have preferred a comment period of at least 90 days. Nonetheless, I am pleased to support today's proposal. I thank the staff and the divisions of Trading and Markets, Economic and Risk Analysis, Examinations, Corporation Finance and Investment Management, as well as the Office of General Counsel, and the staff from other federal regulators for their efforts in today's proposal. And I would be remiss if I did not give a special shout out to recognize the contributions from my former colleagues at the Department of the Treasury, with whom I had the privilege of serving as a detailee to domestic finance several years ago. I look forward to the public comments, and I have no questions for the staff. Thank you.
Thank you so much, Commissioner Ueda. Commissioner Lizarraga.
Thank you, Chair Gensler. Today, the Commission is proposing amendments designed to improve transparency and lower systemic risk in the $23.3 trillion market for U.S. Treasury securities. By increasing the number of transactions subject to central clearing, these amendments should help strengthen the U.S. Treasury market and make it more resilient to unexpected shocks. In the United States, the Treasury market plays a vital role in public finance and in monetary policy. Worldwide, market participants depend on this market to manage risk, post collateral, set benchmarks for borrowing and lending decisions, and for many other purposes. Backed by the full faith and credit of the United States, Treasury securities can also serve as a safe haven for retail investors who prefer the certainty of a reliable return relative to riskier assets. In short, as former SEC Commissioner Luis Aguilar noted in 2015, the U.S. Treasury market remains the largest and most liquid sovereign debt market in the world and continues to play a unique and indispensable role in global finance. Over time, however, the structure and size of the Treasury market has changed in important ways. Between 2007 and 2022, debt held by the public increased fourfold, from $5.1 trillion to over $23 trillion. During this period, electronic trading and expanded participation by PTFs brought with it a significant decrease of 50% in central clearing of interdealer cash trades. This reduction in market visibility carries implications for systemic risk, especially in the context of market disruptions that some have alluded to already. In October 24, the Treasury market experienced unusually high levels of volatility, and liquidity became significantly strained. In March 2020, the global spread of COVID-19 significantly disrupted the market. Even as recently as February 25, 2021, the prices of treasuries dropped sharply amid strained liquidity conditions. The changes the Commission is voting on today are aimed at reducing the risks generated by these market developments and at increasing much-needed transparency. Public feedback on all elements of the proposal will be essential. First, clearing agencies would be required to direct participants to centrally clear all repo and certain cash transactions in treasuries in which they are counterparties. Second, the proposal will require clearing agencies to collect margins separately for house and customer transactions in treasuries. Taken together, both elements may increase transparency, reduce systemic risk, and incentivize more central clearing. Third, clearing agencies will also be required to take steps to facilitate access to central clearing for additional market participants like pension funds and asset managers, and also for indirect participants like investment advisors and registered investment companies. These steps should reinforce the other elements of the proposal and further incentivize more central clearing. Fourth, the proposal permits margin required and deposited with the clearing agency to be included as a debit in reserve formula calculations. This amendment should increase liquidity while maintaining customer protection objectives and current SEC rules. Today's proposal to increase central clearing is an important step in enhancing visibility into and lowering risk in the Treasury market, and I'm pleased to support it. I would like to acknowledge the important work of our partner agencies, which my colleagues have already mentioned, and our fellow financial regulators in overseeing the various segments and participants in the Treasury market. And I would also like to thank the staff in the Division of Trading and Markets, the Division of Economic and Risk Analysis, the Division of Investment Management, and the Office of General Counsel for their hard work and dedication in crafting this thoughtful approach. Thank you.
Thank you, Commissioner Lizarga. Thank you, my fellow commissioners. Going fifth in what appears to be a unanimous vote, you'll find that I'm probably all the appropriate things have already been said, but I guess I'll say some of them again. But in considering whether to propose standards on clearinghouses regarding the clearance of certain trading of U.S. Treasury securities, I am pleased to support these rules because if adopted, I really do believe that they would help to make this vital part of our capital markets not only more resilient, but more efficient and more competitive. The $24 trillion, and I think it grew a little bit in August, but the $24 trillion Treasury market, as my colleagues have said, the deepest, most liquid market in the world. And it's not just that we're saying that, it is the base upon which the rest of the markets are built. Treasury markets are integral to how the Federal Reserve administers monetary policy, but also as the base. It's the mortgage market sort of layers on top of it, the rest of the bond markets, the bank lending markets, all reference that Treasury market. And of course, it's how we as a government and as taxpayers raise money. So you see, we are the issuers, 330 plus million Americans. The Securities and Exchange Commission plays a critical role. It's along with our colleagues at the Federal Reserve and the New York Fed and the U.S. Department of Treasury and the Commodity Futures Trading Commission in terms of Treasury futures. But we play a critical role in how Treasury markets function, including to help ensure that the markets stay efficient, competitive, and resilient. And one aspect of that role is oversight of something called clearinghouses. So why are clearinghouses important? Clearinghouses, as Jessica Wachter said, it's a bit of like a hub and spokes, but clearinghouses and central clearing play a vital role. They facilitate one might call the market plumbing, but instead of that web of bilateral connections, it's a hub in the middle and the process during which cash and securities in a transaction change hands. Somewhat the boring stuff you might think, but rather than having thousands, literally thousands of bilateral relationships among market participants, clearinghouses sit in the middle. As Commissioner Crenshaw said, the buyer to every seller and the seller to every buyer. And while central clearing does not eliminate risk, it certainly does lower it. And it's kind of one of those things, an invention of humans who invented clearinghouses to lower risk in the system. How does it do it? They do so by sitting in the middle and reducing risk amongst and between all those counterparties in what's called multi-party netting. And this also generally lowers the overall margin or collateral needed in the system rather than all those counterparty relationships. Further, central clearing reduces risk through robust rules of the clearinghouses themselves, including for the collection of initial and variation margin. Again, it doesn't take risk to zero, but it's far less risky than leaving those relationships out there in the market. All told, clearinghouses have lowered risk to the public and fostered competition in our capital markets since the late 19th century when we started to have them in our stock markets and equity markets and the like. Though the Treasury market may be considered amongst the world's safest, most liquid markets, that same market experienced several tremors. And I'm not just talking about the three my colleagues just mentioned in 2014, 19, and 2020, but I'm going to go back to the 1980s. Maybe it's because I was a young guy on Wall Street, but these tremors in the early 80s, and there was multiple tremors in the early 80s in the Treasury market, led Congress to give our agency greater authority, and for the first time in 1986, to add clearinghouses for Treasury securities to our mandate. They had done similar thing in the equity markets in 1975 and in the non-Treasury bond markets and the like. And so that authority was really important, and Congress gave us that authority. And Congress appreciated the benefits of clearinghouses. But as my colleagues have said, things have changed, particularly in the last 20 years. In 2017, only about 1 out of 7 trades in the cash market, or 13%, were being centrally cleared. In the 1990s, significantly higher ratios. You see, prior to 2000, all users of these platforms that are sitting somewhat in the middle as well, interdealer brokers, were members of the clearinghouse. Primarily, it was something called primary dealers trading on them, and thus those trades were centrally cleared. But since then, several things have changed. My colleagues have mentioned the increased digitalization of the markets, the increase of principal trading firms trading, and further, the interdealer brokers currently are taking on some clearinghouse-like functions. It's like we have multiple nodes in the system, but currently those interdealer brokers do not get regulated like clearinghouses and don't necessarily have the robust internationally accepted standards about clearinghouse risk management. So the IDBs, which sit somewhat as mini nodes in the middle of these markets, often are bringing just one side of the trade into central clearing. And this occurs when the interdealer broker is a member of the clearinghouse and trading with non-member counterparties, including those principal trading firms and including others like hedge funds and the levered accounts that were discussed earlier in the market. Thus, I think there is more work to be done with respect to the amount of Treasury activity that's centrally clear. This is important because, as noted, we've had continued tremors in 2014, 2019, and 2020 in these markets. Our Treasury markets would benefit from today's proposals, especially during stress times that may come in the future. Now, today's proposal also concerns expanding the customer side, and as Commissioner Crenshaw mentioned, with $3 trillion trading a week in the cash market and $4 trillion daily in the repurchase market, they're both really important markets. The repurchase market, remembering what Jessica said, that's funding the Treasury markets, $4 trillion a day of, generally speaking, overnight funding or overnight repo. So broadly speaking, the proposal would put forth the scope of clearing in each of these important markets. The cash trading, a little narrower scope, taking into consideration the broad market and the economics. In the repo market, a wider scope, but we look forward to comments. Also, the market is looking to do, and what this proposal is looking to do, is try to enhance customer clearing. I won't go through the 3 points because the public's already heard the 3 points, but in strengthening the Commission's rules around clearinghouses, transacting trades in Treasury through what's called gross margining rather than net. In a word, this means that the big members of a clearinghouse no longer can net their house account, or you might think of it as their proprietary trading account versus customers. They wouldn't be able to do that. The customer margin would have to stand in a separate pool from the proprietary trading. An important innovation that we've put in place at the SEC years ago around trading and security derivatives, an innovation that was also put in place in interest rate swap markets. The proposal would change the broker-dealer customer protection rules as Randall went through, and I think this would significantly enhance indirect clearing or customer clearing, and also address any cost concerns with regard to the broker-dealers themselves. And of course, it would also have require clearinghouses to have policies and procedures designed to ensure they facilitate such clearing services for all eligible transactions, including those indirect participants. This is the latest number of rules designed to enhance the Treasury markets. We look forward to public comment on all aspects of the rule. I just want to give a shout out for a number of agencies, and my colleagues have done this too, but I particularly want to thank the colleagues in what's called the Interagency Working Group on Treasury Market Surveillance. But in the main, this is the Department of Treasury, the Federal Reserve Bank in New York, our colleagues over at the Commodity Futures Trading Commission. We would not be able to put this forward if it weren't for both the leadership at the top from Chair Powell and Vice Chair Brainerd and Secretary Yellen and Undersecretary Leong and the head of the New York Fed, John Williams, but their staffs have really given us a lot of feedback as we've been collaborating and discussing these possible proposals. They've all been giving us thoughtful commentary and research. Also, we've been benefited from research outside, and there's too many people to name, but academic research, former government officials that have weighed in, including Secretary Geithner from his time living through various crises and the like. And I'd be remiss if I didn't mention former Commissioner Roisman, because when I first got to this job, or even before I swore in, it was Commissioner Roisman and I who started talking about this, and I looked at what he had written and his public voice on this in 2019 and 2020, and we formed an early collaboration and working on this. So a tremendous amount of effort. Of course, I'd also like to thank everybody at the Securities and Exchange Commission. Many names to read, so I will dispense with that. But from the Division of Trading and Markets, the Division of Economic Risk Analysis, the Division of Investment Management, Exams and Enforcement, as well as the Office of the General Counsel, and all of my colleagues at the Commission and their able staff in their offices, and Cy Rao in my office, and Amanda Fisher. With that, how do commissioners vote to approve the division's recommendation to propose both amendments to the standards applicable to covered clearing for the U.S. Treasury securities regarding their membership requirements and risk management, as well as amendments to broker-dealer customer protection rule?
Yes.
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 The ayes being unanimous, isn't that a nice word? The ayes being unanimous, the recommendation is approved, and I think it will be put in the Federal Register. I think it will be out for public comment for 60 days from the date it's in the Federal Register. Often it takes a little while to get in that Federal Register, but we're going to post it on our website hopefully later today as well, so the public can see it well before that occurs. With that, I thank everybody, and the meeting is adjourned.